Neelotpal Sahai, Head of Equities, HSBC Global AMC, is joining us right now. Neelotpal, hi, good morning. Thanks so much for being so patient and waiting by for us. Want to start with your view on the financial space, because a lot has happened in the last couple of months. In fact, this week itself, we've had an RBI Governor's shocking exit, followed by the reappointment of another one just within 24 hours of that. How are you reading into the financial space with regard to NBFCs and corporate banks, especially the private lenders, given that 3 out of 5 of your top holdings are private banks? What will be your strategy going forward for the space?
Yeah, good morning. Thank you for having me on the air. This financial sector is the sector that we have been positive on for quite some time, maybe in last 3 to 5 years. Within the sector, our preference has been, as you mentioned, the private banks, private financials, and the reasons are very simple actually, because they have been able to increase market share, grow faster than the rest of the financial space, to be able to raise capital as and when required, maintain sound capital base, and also have lower NPA in general. A couple of banks did have an elevated NPA level some time back, but right now what we are seeing is that, and probably believe that the NPA cycle, NPA creation is past its peak, NPA recognition is also past its peak, and NPA resolution is well underway. So we are likely to see a lower credit cost definitely in FY20, and maybe as early as in third quarter and fourth quarter as well. So this will lead to a meaningful increase in the profit of these banks. Also, that what we are seeing for last year and a half or so is that the credit growth has picked up. Now it's into low teens to mid teens, and probably will accelerate further. And there again, the private financials, especially the private banks, should be able to gain a further market share. So that will continue to remain one of the important and the bedrock of our portfolio that we have. The recent changes which is happening in the financial sector will probably not impact the private banks as much as some of the non-banking finance companies that much. So in the past, these banks were gaining a share from the PSU bank counterpart, but now increasingly they can also gain market share from some of the weaker non-banking financial companies. Not all NBFCs probably would be hurt, but the weaker ones, definitely with the ones with the weaker liability franchise, will definitely get hurt.
Right. You know, we've officially also entered the election season. While the markets did shrug off the impact or the surprise victory of Congress with 3-0 against the BJP, how are you going to navigate through this market for the next 6 to 8 months in the run-up to the Lok Sabha elections? What would be your strategy? What will be the pockets and themes that you will actually bet on, specifically the kind of uncertainty that we're bracing ourselves for?
So elections is a reality, and elections is an event that we have to navigate with. But if it comes to the change in the portfolio on account of election, that will probably not happen. In India, elections happen all the time, and this is an event around which the markets do tend to become volatile. But what we have also seen in the past is that the outcome of the election is not that much on the companies and on the markets beyond a point. If we see last 3 elections, general elections, and different governments have been formed after the 3 general elections, but the markets 12 months after those elections has been given a positive return in all the 3 elections, and the returns has varied from somewhere between low double digit to almost 30-35% also in one of the years. So the impact of the election is felt only in and around that, and the volatility is high. But when it comes to looking at the portfolio with a view of the election, we wouldn't like to make any changes on account of that. What we would like to focus on in terms of the portfolio is to look ahead of election and see what part of the which kind of industries and companies will likely sustain the growth, and that's what we would be focusing a lot more on.
Okay, Neelotpal, give us your sense on what would you avoid in the current market environment. We often ask people on the sell side to give us a sense of where they're bullish, but what about where you would want to be a bit bearish and circumspect in this market?
See, the investment part of the economy and the result in the second quarter though has been much better than expected, especially in the capital goods segment. But what we do believe is that that's on the weak wicket right now. Although there has been a nascent signs of a private sector capex there, but probably the private sector capex will only accelerate post election and once the new government puts in agenda for the growth for the next 5 years. And also from the economic perspective, what we do believe is that the private capex will come in when the return on investment is meaningfully higher than the cost of capital, which is not the case at this point of time. And also in the capex intensive industries, the capacity utilization is on the lower side, as not at a place where the new investment comes in. So as of now, the investment cycle is standing on one leg, and that is that of the government capex. Government has been rightly investing into this space for quite some time, and but what we believe is that in the run-up to election, probably some part of the government's effort and resources will be going towards addressing agrarian distress as well as driving the rural economy, because probably that's the need of the day, and if should that happen, then the only stand that the investment cycle has got, that the government capex will also weaken. So that is one part of the economy that we are not so positive on, at least in the near term, and that makes us less positive on the capex intensive sectors like utilities, energy, and in some way industrials as well.
Okay. Having said that, how are you? I know Karunya asked you a little bit about the event risk in elections, but would you base certain policy-sensitive sectors, their investment decision, ahead of elections? We often see fertilizers, sugar, some of even PSU banks for that matter, rally up in an election year, or see a pre-budget rally. Do you think that structurally the policy sensitive sectors may come to the fore in the coming year and you would want to take a call on them?
So a part of the answer is there in your question itself. As you mentioned that some of these policy sensitive sectors do tend to be volatile and sometimes go up also appreciably just before the election, but once the election is over, because of these overhang of interference or the policy changing, they do come back to reality and normalcy. Hence that's not some of those sectors that we are positive on. That's not going to be a significant part of our portfolio going forward as well. None of these sectors.
We'll let you go at that. Thanks very much for joining us with your perspective on the markets. Really appreciate your views as always.
Thank you very much.
Okay.